Just with the quote that he told our producers, and I want you to expand on this. I don't see today's sell-off as all that concerning. Okay. Why?
Well, Scott, look, the S&P has risen 150 points from low to high just in the last 3 sessions ahead of today. So, yes, we're giving back about 50% of that. But in general, this has been a very strong rally, not only from last October's lows, but from, late December and most of January. We look at leading sectors like semiconductors, transports, home builders. They're all up between 12 and 18% for the year. We've just had industrials breaking out in relative terms to the S&P. Now we're seeing a little bit of a slowing down in the move up in yields, which is important. So everybody now is uber hawkish on Powell, saying he's as hawkish as he's ever been. Rates are not going higher. You look at the 10-year and the 30-year, they're actually down about 10 basis points from recent highs. So, my work shows that rates are close to peaking out along with the dollar, and they should both start to turn down pretty sharply over the next couple months.
The 2-year at 5% doesn't mean anything significant to you?
Yeah, certainly. I'm not an economist. I know there are a lot of armchair economists out there now. My feeling is that it's best to concentrate on price action, and the movement in the 10-year and the 30-year are really going to be key from how I look at the market. But let's also look at seasonality for March. Pre-election years, they do tend to be down, if not flat, for the first half of March. They bottom right near the 10th trading day of the month, which is actually next week. So I think any further drawdown is actually not going to last more than 3 to 4 days, and we're going to bottom out and turn higher. So that could coincide with next week's economic reports. I expect to see inflation start to roll off. I think that, in general, stocks are still in excellent shape. Momentum is good. We have nearly 60% of all stocks above their 200-day moving average. I mean, that's impressive. This isn't something that we run to the hills because of one down day. S&P was up. It went from 39.25 to 40.80 in 3 days, and we didn't really talk about that. But we're down one day, and everybody thinks they have the Fed figured out. So, I think we have to be patient a little bit.
Well, I mean, I think, the market's just reacting to what the chair himself said, right? This idea of higher, faster, and for longer. It seemed like Fed funds had been moving in that direction, and the bond market had been moving in that direction since the last jobs report. It's the very stock market you speak of as showing so much resiliency that some suggest was delusional or not paying attention.
Well, trends are still very much intact. So if anybody's delusional, it's those that are calling this real bearish and that we have to have a big sell-off. I mean, if anything, the trend's back what I'm saying with regards to breadth. Sentiment, look at AAII, reached the highest bearish levels this year so far, 44% bears. People are certainly paying attention, and they're concerned for a lot of the right reasons. That doesn't necessarily mean the economy has to go into a recession right away with such a strong labor market. I mean, my own real estate cycle, you look at the 18-and-a-half-year cycle for real estate, it shows a bottom near 2028, 2029. Not that we have to go down right away. If rates start to really start to sell off and pull back pretty dramatically, I think we're going to weather this, honestly. And I'm no economist myself, but I'm very much in the no landing camp for this year. I think we push it off a couple years. The market resilience, there's never been a time when, the first 5 days in January is up 1.5%. Following a down year, the average return is about 22%. And so, look, in general, momentum and breadth support the idea. So does seasonality that March and April should be actually quite bullish. So I'm a buyer on pullbacks. I don't think we get under last week's lows, which is 39.28. So that's really my line in the sand.